All right, so we are going to start with an asset pricing tutorial. Okay, so I just went to geogebra.com or geogebra.org, start calculator, and I'll show you what we're doing here. Okay, so the first thing we're going to do is just talk about pricing and an initial asset. Okay, so let's just say, what do we want to do? We want to figure out, we want to be given an asset and we want to kind of tinker with it and see what happens to our market. So the first thing I'm going to do is I'm just going to make a vector here and I'm going to say, all right, this is sort of what we can consider to be an asset. And if we put some text up here just to label our axes, so if we call this the price and time 0, that's a 0. Okay, and then this right here is the payoff and state 1. So since we only have, in time 1 and state 1. But in this case, we really only have one state. It's just this state right here. So that means we're kind of looking at a bond or a CD or something that's riskless. So our payoff is going to be something around 1, right? So the price in time 0, that's today, is going to be $1. You're going to pay off $1 in time 1, so maybe a year. So really what happens is it looks like a little bit over to the right because you're going to pay $1 now and you're going to get a little bit more than $1 in the future. Or, you can kind of think of it the other way and say, all right, if I'm getting $1 in the future, I'm going to pay a little bit less right now. So that's kind of the bond pricing. A bond would usually have a face value of some number, say $1, and then you just pay a little bit less for it today. Okay, so what we're going to do is we're actually going to fix our payoff in time 1. We're just going to fix it to be 1, and then we're going to tinker with this price in time 0, okay? So how we're going to do that using GeoGebra, I'm just going to delete all this stuff, okay? What I'm going to do is I'm just going to make a parallel line. So I clicked parallel line. I want it to be parallel to this, and I want it to be at 1. That's going to not let me go at exactly 1. So I'll just click somewhere, and I'll go back to this view, and I'll make this, I'll just make it 1 to make it easier for ourselves. So 1, comma 1, and I'll delete all these decimals. Alright, so now this line is exactly along 1. Alright. Okay, so now what I'm going to do is I'm actually going to put another point on this line, and I'm going to draw a vector. I'll just do it this way and say vector, and that's point B. Okay? And now what I'll do is I'll actually just hide A, and I'll hide this line, just so they're not, so they're not in our way. We just used them for construction purposes. So now here we are. We can slide this around. And this vector is basically, this is our asset. And what we're saying is we've fixed our payoff in time 1. And, since it's riskless, there's only one state. And we're varying the price in time 0. So right here, if we had 1, that would mean our interest rate was 0. Down here, if we move this down, we're getting a higher and higher interest rate because, let's say, what are we paying? About 85 cents right now to get $1 in the future. And then here, this would mean we're doubling our money, right? So if we pay now 50 cents and in the future we get $1, okay? So that's really all we're doing. We're just tinkering with this thing. Okay? And so now in our market, the basic, the idea is we can buy or sell as many of these as we want. So I'm really just going to extend that little vector. And now this line represents our whole market, right? So I can move this up or down, and now it's moving the whole market. Because, if this is 1 unit of the asset, well, we can just buy 2 of them, right? So if it was 50 cents today to get $1 tomorrow, well, we can just buy 2 of them and pay $1 today and get $2 in the future, right? So now there's a couple more things to think about. One of them, what we like to do is we want to say, all right, let's try to pick a payoff in time 1. So let's just pick some number here, and let's figure out how much does it cost today. And so what we'll do is we'll just drag this along this x-axis, the payoff in time 1, and then we'll read off the price today. So I'm going to come down here and I'll just do a parallel line between here and D, right? And so now you can probably imagine what we're going to do. We're going to click that intersection, and then I'm going to do another parallel line between this and this. I feel like I'm moving too fast. I'll slow down. Bingo. Okay. So now what have we done? I'm actually just going to hide this C real quick just because I don't really show. I'll just do it like this because we don't super need it. I'm going to hide the object. Okay. And in fact, we don't really need this one either. Okay? Because really we're just moving the whole market. So what we're doing is, as I move B, right, and what was B? This is just like our initial asset, right? So if it's getting $1 tomorrow, this is just moving the price at which we have to pay today to get $1 tomorrow. And let's leave it at 1 for a second. So now when we tinker with this, basically what we're asking is how many of these assets do we need to buy to get, or well, we're saying, okay, what payoff do we want in time 1 tomorrow? So let's say, okay, we want $2 in the future. So what are we going to have to do? We're going to have to get 2 of these. And how much does that cost? It costs $2 today. So what we're doing here is we're saying, all right, we're really making some, like, you can call it an abstract asset, or you can call it some fictional asset with a payoff, say 3.5 or 3.25 at time 1 in the future. How much is that going to cost today? It's going to cost $3.25. But if we move our asset a little bit, maybe make it, now we have an interest rate, right? Because we're paying a little bit less. We're paying 85 cents today for $1 tomorrow. Now all of a sudden, to still get that $3.25 payoff, we're paying fewer than $3. So now if we so just to really hit it home, if we crank this price up, you can see how this price is going up as well. Because to get the same payoff in the future, it really depends on what your price of this first asset is. Okay? So now, in any market, what are the 3 big questions we have? We have completion, whether the market is complete, and then we are also wondering, does the law of one price hold? And also we're wondering, is there arbitrage in the market? Is the market arbitrage free? So let's go ahead. I'll just write that here. Where's my text? Okay, so complete. Oh, didn't mean to do that. Just type in here, complete. Law of one price, and then arbitrage free. Okay, I'll just put those questions here. Okay, so complete. What that question is it's wondering, can we get anywhere in the payoff space in the future? Well, our whole future only has one state. So the question is, could we guarantee ourselves, let's say $5 payoff in tomorrow, right? Well, all we'd have to do is just move this over, and sure enough, we can get that as long as we pay $4.50 today. And now you're wondering, okay, well, can I get this? Yeah, you can get any of these payoffs you possibly want in the future. And that's what a complete market is. So this market is complete. Let's see if I can edit this. Complete. Yes. Okay. So now the law of one price. We're wondering about the law of one price. Does it hold in this market? And the answer to that one is also yes. Now, that one was almost by definition. We have one asset here. And no matter what we move this payoff in time one to be, we know its payoff right here is linear in the payoff in time one. So the price is linear in the payoff, right? This is a linear function, right? In particular, it's kind of just a proportionality function, right? There's no y-intercept. So when we move this, that goes up linearly. So the law of one price also does hold. And also it's a single valued function, right? So when we're trying to get a payoff of $2.50 in the future, there's only one possible price to pay today to get that. And so that's sort of what the law of one price means. Okay, now the last question is this market arbitrage free? And, there's a couple of different definitions of what arbitrage free means, or at least people like to explain it in different ways. This market right now is arbitrage free because to get $2.50 in the future, you have to pay $2.25 right now, right? So to get money, you have to pay money. And here you can see the same thing is happening, right? In any of these cases. And also, if we go negative here, that's saying, you're going to have to give money in the future. But that's fine because the price is also negative. That means someone's going to pay you now so you get money in the future. So that's just, and that seems reasonable. That's the same thing as just selling something, right? That would be like short selling. So that's fine too. So I'm going to go back. But so have we proved it's always arbitrage free? And the answer is actually no, because if we move this all the way down here, boom. So now this market is not arbitrage free. Because what is this saying? This is saying our initial asset to get $1 in the future state, to get $1 tomorrow, to get $1 next year, someone is paying us 75 cents right now and then giving us $1 in the future, right? So this market certainly is not arbitrage free because you can make money for no reason. You're getting paid today and getting paid tomorrow and you have no risk, right? So this market is sometimes arbitrage free. Sometimes. When today's price is greater than 0, we are arbitrage free. And when it is less than 0, it is not arbitrage free. And you're probably wondering, what about it exactly 0? That's kind of a small case that I don't really want to get into right now. So this is kind of the explanation here. This is really what we're going for. Actually, I'm going to put some carriage returns in there sometimes. There we go. That's a little better. Okay. So I'm going to see if I can move this. There we go. Okay. So this is really just a market with one asset, law of one price holds, and we're trying to figure out completion, law of one price, arbitrage free. So that's all we got. Thanks.